Hey guys, how you going? It's Daniel Walsh of Your Property Wealth. Today I want to show you the difference between just buying purely for cash flow and or making a property purchase which is well balanced between cash flow as well as capital growth. See, what happens is a lot of people just buy for cash flow or they just see the yield and think that that is a great investment. But what they neglect is the capital growth side. And remember, when you're buying a property, the capital growth is what's going to allow you to buy more property. You won't be able to just get a high cash flow and be able to build this massive portfolio without the growth. Let me just put an example here on why cash flow is not always the best avenue just to be looking at, and that you need to be looking at both. So let's say in cash flow, we bought a property and it's a townhouse for $200,000. Let's say that that gets a yield of 7%. So a lot of people will look at that on face value and say, well, I've got a property for 200 grand and 20 for 7%. That's a really good return. That's a great yield. But what happens if this only returns 1% growth? Now you're getting 1% growth and you're getting that. So you're getting total return of 8%. So you get total of 8. Now, the 7% yield will be paying for the mortgage and all the expenses, which is great. So we've got a property that's not costing us anything, but the growth was 1%. So if the growth is only 1%, what's that? On $200,000, we've made $2,000 in equity. So the equity gain was $2,000. Now, unless you're on a higher income or you can save really well, that will not get you to another property. You're not going to be able to build your property portfolio just because of that, because you've only got $2,000 to play with, and that means no house, and you're going to have to do this for a long period of time, even if you are paying the debt down to be able to build your portfolio. Now, this is an example of a property that we bought last year, so this is 12 months worth of growth, and when we bought this property, it was not necessarily for yield, but we were chasing a lot more short to medium term growth. So we weren't just looking for yield on this property. What we were looking for is growth so we can continue building the property portfolio. Now, we bought this property in Melbourne, and this Melbourne property was $440,000. Now, we were able to get a yield of 4.5%. Now, the yield of 4.5% on face value, people would say, oh, that's a little bit lower yielding, I like that property. But the difference was we did a lot of research to uncover why this property is going to grow in the short to medium term. And in 12 months, we had growth of roughly 18%. Growth. So after all of that, we ended up having a total return of 22.5%. So we had a 22.5%, or we had a total over here of 8%. Now, if you were to look at it at the start, 7% yield looks great, 4.5% yield doesn't look as attractive, but the research that we uncovered for the growth side of things was that we're going to get a lot more growth in the short to medium term. We ended up getting 18% growth and a total of 22.5%. So what that means is we got $80,000 in capital growth in the 1 year. From the $440,000, 18% growth equals $80,000. And with that $80,000, we went out and we could buy another property. So as you can see, here is the difference between buying a property for yield and growth and making sure that the portfolio that you are putting together has both in it and not just cash flow. If you hear of somebody that says, oh, we're only chasing cash flow and we're not looking at the capital growth side of things, then how are they ever going to build a property portfolio if you're not looking for growth? Remember, cash flow allows you to hold the property. So that allows you to hold the property, which is great. But without the capital growth, how are we going to build the portfolio? We could have something that's lower yielding at the start, but that's going to grow more and in return build that property portfolio and continue building that property portfolio easily over the next 5, 10, 15 years. This is how I built my portfolio. I had a mixture of cash flow and growth in my whole portfolio and making sure that I diversified my portfolio throughout multiple states. because not every state is going to grow at once. Make sure that you don't just look at cash flow, but you also look at the research on an area and why it's going to grow, because it's the key data research on why that area will grow that will allow you to build a successful portfolio. If you like my videos, please like, share, and comment. And until next time, guys, have a great day.